Welcome to the Earn Your Marks podcast, presented by Pro Exam Tutors, the only podcast you need to pass the CFP exam and become a certified financial planner professional. Here's your host, Sev Meneshian.
Hey, welcome to the Earn Your Marks podcast. I'm Sev Meneshian with Pro Exam Tutors, and I'll be flying solo today without my podcast partner, Nelson Green. He'll be back soon with us again. Today, I'm joined by Jerry Pecaro. He's a certified public accountant licensee. Jerry is one of the very knowledgeable and experienced tutors here at Pro Exam Tutors, and he helps those that are looking to pass the very difficult, very challenging CPA exam, specifically in the FAR and BEC sections. He also helps CFP candidates who are struggling with the vast amount of tax information that's tested on the CFP exam. Jerry is a member of the American Institute of Certified Public Accountants, where for a number of years he worked as a consultant writing and correcting exam questions. So for those of you that have taken the CPA exam, Jerry had a hand in some of those questions that were presented to you. So I don't know if that puts a target on his back or anything, but nonetheless, he had a hand.
He's used to it, yes.
Hand in those questions. He's also consulted businesses in regard to their accounting needs, including business turnarounds, corporate financing, strategic planning, and forecasting, among other areas. And so with that, welcome, Jerry.
Thank you, Sev, and hello to all the viewers of the CFP exam, Pro Exam Tutors.
Yeah, and hopefully with another one of our podcasts here, just trying to get students over the hump with these exams, whether it's the CPA or the CFP exam. And as we're talking through, Jerry, you and others will have to forgive me. I will probably say CPA when I mean CFP and CFP when I mean CPA. So
we understand the distinction. Yes, good.
It's part in the same bucket, I suppose. So
it is.
Well, the reason I asked you to be on today, and thank you for sharing your time, is that as far as the CFP exam is concerned, one of the areas that gives candidates fits, I mean, the most difficult time is the income tax portion. And I think that's likely because most of the students that are sitting for the exam, they just don't have any background in taxes. I remember while I was going through the curriculum, I thought everything would be okay until I got to the income tax portion. Right. Thankfully, everything went my way, but I was not looking forward to those tax questions. Honestly, when I took the exam, it was my only experience with taxes was really just filing my own taxes. That was it. I mean, didn't know anything much about depreciation. I think at that time, maybe I owned a rental building, but I just had a tax person take care of the depreciation. And I'm sure that tax person popped those numbers into a software and all.
Yes, most assuredly did.
Yeah. And
right.
So, but with that said, one particular area that frustrates students is the kiddie tax. So to start out, can you give the listeners some idea of, let's say, what the kiddie tax is? Why is it even in the code? What's it there to prevent? I guess big picture, what is it all about?
All right. Well, the kiddie tax, and really here we're talking about a legal framework.
Okay.
Right. So therefore, when it's hard to grasp intellectually, it's because it's law. The concepts are not something that makes sense. Right. So, I understand why students have a difficult time in taxation. But the kiddie tax was born out of the fact that many tax professionals, including myself back in the day, would try to shift income to a lower tax bracket.
Okay.
Therefore, the kiddies. So there's unearned income that we could easily shift over to a child or a group of children that were, dependent upon the parent, and we would be able to reduce the overall tax burden. Okay. That's really where it came from.
Okay, and then we're talking about parents that And so I don't know exactly when Kiddie Tax was introduced. If I had to guess, it was in the 80s, maybe when, let's say, mom, dad, or whomever were making a higher income or making let's say a decent income. But from what I know, the tax rates in the 80s were at the higher end were up there. I mean, they were astronomical, I think.
Yes, they were. They were extremely high, and we looked to shift income. And the income, of course, was unearned because the parents had W-2s. So we're really focusing on in the Kiddie Taxes unearned income.
Okay.
Right. And that is specifically not salaries or wages, or receipts for work, W-2. It's taxable interest, dividends, capital gains, unearned income that we shifted over to the children's side because we knew it would never meet the threshold in most cases, right, for them to be subject to tax.
I see.
Right. Yeah. So we had that clearance of dependent and exemptions financially,
Okay.
so that we wouldn't have to generate a return.
Okay. So now that, let's say you've got the parents making a decent income. Maybe they have some, I don't know, back then, I don't know, AT&T stock or something. That's something that's kicking off a good deal of dividends.
Right.
And so they would then shift so they would, let's say, gift the AT&T shares or whatever company it was, or rental real estate, whatever.
Mhm.
They would shift it over to the kids. So would that be sitting in, I mean, I don't think 529s were around back then. So that would be sitting in what type of account then?
It would just be in their name.
Just in their name. Okay.
Right.
And so before the Kiddie Tax was introduced, now we could have Junior pulling in $15,000-$20,000 or whatever it was, and instead of paying, very high rate of, I don't know, 40%, I'm just making that up, but
That's
they would
right.
pay maybe nothing, or 5%,
Right.
somewhere around there. Okay.
That's exactly the premise. So that's why once you understand that background, then it's easier to grasp what we're talking about here. It's unearned income that was used or used to be shifted to a lower tax bracket. And we would do it judiciously so that we didn't generate a return.
Okay. And then the parents would have to be okay with the fact, I mean, they were truly giving these assets away to the kids, correct? I mean, there was no way that they could grab those stocks or real estate or whatever it was, CDs. They couldn't grab that back from the kids.
Yes, that was always the understanding, is that the parents owned it, signed it over to the children, and they could sign it over, quite simply on the document itself, on the tax or bonds. Quite simply just transfer it over to them and then transfer it back, because for the most part, they were not of legal age, right? So in the Kiddie Tax, the way they structured it now is there's an investment income threshold of 2,300 unearned.
All right.
Right. And once it hits that, then they're saying you're going to be taxed, and you're going to be taxed at the parent's rate. So they figured the whole thing out eventually, right? And what they did was they said that anything over 2,300 unearned income would be taxed, and taxed at the parent's rate if it resulted in a higher tax liability.
Okay. And that's one of the areas that confuses students. Let's say I can only speak on my end to the CFP exam, but one area that confuses them, they'll ask me, well, once they get the income over 2,300, the confusion comes in and they say, well, okay, now are mom and dad being taxed on that income above 2,300, or is it the kid himself or herself? So
exactly right. And that changed. It changed in 2018, 2019, to where now it's simply an addition to the parent's income.
I see. Okay. So that, I don't know if that complicated things for the taxpayer or made it easier. I'm not even too sure about that part.
Right. I think, essentially what it did is it limited the amount they could shift. So they're going to shift 2,300 and then leave it at that.
And then that will be it. Okay. All right. Now, we were talking about unearned income. What if the kid is just flipping burgers or running his own business or something? He just has earned income. This seems to be another area of confusion. So does the kiddie tax even apply to somebody who has only earned income from a job or a business?
Yes. So generally what they say, it's computed in the same manner as an individual. So conceivably a child, and they're really talking about an age group of under legal age all the way to the age of around 24 as a full-time student. You know how that clause kicks in many different areas.
Right.
So yeah, that's what they're talking about. And that person is simply taxed at individual rates. So if they meet the threshold of taxation as an individual, even though they're a child, they would have to include on their tax return their unearned income.
Okay, but if it's just earned, then we're only worried just about the kid. That's it.
Right.
There's nothing else that comes in.
Right. So, unearned is something that is outside of what we would typically classify as W-2 or actually receipt for work.
Okay.
Right? That's what our focus is here. That's unearned. And that's what the tax code focused on, is trying to prevent shifting of large amounts, whereby you could, with personal exemptions and deductions, get by a considerable amount of money without paying any tax.
Okay. And so now if we have a kid who's working, so now we have the W-2 coming in.
Right.
And whether mom and dad have shifted, or grandma, grandpa, whomever have shifted some assets over to them, maybe it's just an outright gift and they weren't trying to avoid any higher taxes. So now the kid has earned income, and then they have unearned income as well. That's also from the exam practice questions that I coach students with or on. That's where some further confusion comes in, because sometimes we'll have I don't know, to $10,000 of earned income and $3,000 of unearned income. And there seems to be that there's these, you would pick one or two of the standard deductions. So can you clarify that part?
Right. So if the child meets the income test for earned income and gets into the areas of income where it is taxed, he's taxed as an individual on his W-2 and also his unearned.
Okay.
So yeah, in other words, he's seen as an entity, a taxable entity, because he has earned income and unearned income combined that puts him into and above the threshold for taxation. So he would simply file as an individual, and he would have the same deductions, available to a single taxpayer.
Okay, but isn't there the case too where you're going to pick the greater of the two standard deductions? I mean, if the kid has $5,000 in earned income, isn't his standard deduction higher? Wouldn't it be $500 and then $5,000
right
plus the $400?
Right. So they play that margin, so to speak. They're going to shift unearned income until it gets to 2,300, and then put that on top of the child's earned income. And by most accounts, he's probably not going to pay any tax. He may be required to file a return, but he won't be paying any tax.
Oh, I see. Okay. Yeah. And so with that, the other part of the confusion is there is no such thing as two standard deductions. You're just taking the higher of the kiddie tax, let's say standard deduction, or you're taking their earned income plus that 400, and we just pick the higher of the two. And is this accurate to say then we just take the excess above that? And I think you were saying this, is that you take the excess above that, just generally speaking, I suppose, and then we apply the kiddie tax or the parents' tax rate, their highest marginal tax rate, to that excess amount.
Right. So what they're saying is once you exceed the unearned threshold of 2,300 for a child, then you have to add it to the parent's income.
Okay.
because now they're seeing it for what it really is. You're shifting income to a lower tax group. So
Oh,
yeah, the 2,300 is where it all occurs. So unearned investment income of 2,300 is the tripwire.
okay. So it's the IRS is almost saying it's like, mom and dad, nice try. You're trying to get away with this. We're gonna bring that amount in excess of the standard deduction. It's coming back to you.
That's right.
You're not going to be running away from it. Okay.
Yes.
If we've exceeded that threshold, is there, and we won't do a computation just because in this format, and this would be a computation more like in a class format, but what if the kid has unearned income from, gosh, we can almost start saying CD income now that CD rates are actually paying something again.
Right.
And then capital gains from maybe some sale of stocks or other type of capital assets. Are those somehow split? Just ordinarily, if you and I have ordinary income, we'll pay ordinary income tax on CD income, whatever it happens to be. We'll also pay capital gains on tax on stocks that we have gains. And so we, in a sense, we split those on the tax return. So we're paying the appropriate rate. Is that done as well as far as the kiddie tax is concerned?
Well, all those types of incomes that we would be considering unearned income are going to be subject to the 2,300. So what we're saying is you're talking about interest income that's taxable, wouldn't be municipals, dividends, capital gains, all those sources of income that are not W-2. And I find that thinking and hooking into W-2 really gives you that hard distinction of what we're talking about. So those types of income, unearned income, not W-2 income, is where the 2,300 applies. And then once the 2,300 applies, then you're, looking at adding anything over that unearned to the parent's taxation.
But if let's say if the kid brought in, I don't know, $5,000 or he's $5,000 over the threshold, half of that 5,000 comes from would be taxed as ordinary income, and then the other half are from the unearned income is from capital gain sales. Is that a correct way of thinking? Like, oh, you might pay 15% or 0% on those stock sales, but you might pay, I don't know, 10% on the CD income. Is that?
So yeah, what you're saying is, do they lose their look through? In other words, are we seeing them in the same fashion because they came to the child as it would if it came to the parent? Capital gains would be subject to favorable rates. So yes, it would be, it would still maintain the provisions of that type of income.
Okay, so then that's another point of confusion I wanted to clarify for listeners, because and I don't know if they get that nasty with questions on the CFP exam. Nobody knows what they're going to ask in the first place, and then you can't divulge what was asked on the exam anyway. But there are plenty of practice questions, and tax practitioners will they'll come up with questions that might ask, okay, well, you were over the threshold, and this much was from just the income from a CD. This part was from stock sales, and now go out and figure out exactly how much taxes are going to be assessed based on these two different types of income, even though they fall in that same bucket of unearned income.
That's right.
Yes, I mentioned, I don't know if they'll get that.
Yeah, that's pretty deep. Yep.
Yeah, that would be, and who knows? You might written a question like that for the CPA exam. Who knows? But well, I don't want to get you in more trouble than you already are with the students that have seen your test questions on the CPA exam. So, okay, well, hopefully that clarifies some parts of this. I just have a feeling on the CFP exam, at least, that this is a test topic, or it's one of the topics in the curriculum. I have a strong feeling that could show up on an exam, maybe not on every exam cycle, but you never know. I think it's a good area that students have to be well versed in, and maybe takes them a couple hours to understand it. But I think hearing it from a professional, somebody who's been in it before, somebody who's written test questions before, I think that should certainly help the students too. Any last thoughts on whether they're tricks or different ways to think about the kiddie tax that may help a student understand the question better? You were very clear about, okay, separating W-2 income from anything else, but is there anything else that you can think of? If there's not, that's okay, but
yeah, I find that hemming it in somewhat for the student is helpful. In other words, looking to the key tripwires for this type or any tax really is helpful to get an intellectual foothold on it and to remember it for an exam. So here we're really talking about the background of how it all came to be. And parents were shifting income over to children who were, under their care, and they were avoiding taxation. So obviously over time that was picked up on. And then the next point you want to focus on is the threshold, and the threshold being 2,300 of unearned. And that's where the distinction between W-2 and unearned comes into play. Once you have that, and maybe adding to that the age group of up to 24, if they're a full-time student, qualifying or subjecting them, so to speak, to the notion of being a kid and kiddie tax, then I think you have everything you really need, those three principles, to really hem it in and to say and to make a good choice on the exam as it pertains to kiddie tax. And then lastly, simply that we are adding it to the parents' income and their tax liability, essentially because we're saying that's where it really belongs, this child who never worked. And, now conceivably, there's children who've been left from as an heir from parents, grandparents, as you mentioned, stocks, investment securities of bonds or debt securities or equity securities. So it is conceivable, but 2,300 is where they're going to cut it off, and then they're going to consider it as if the parent is doing essentially what we did.
Okay, and that means too, back whenever the kiddie tax came about, there must have been a lot of families, a lot of taxpayers that were shoving these assets off onto their kids. I mean, if it was just a handful of families or taxpayers, it probably wouldn't have gotten much attention. But I think it probably goes back to in the who knows, maybe in the late 70s, early 80s, when those tax rates at the higher end were very high. Then it made sense for some aggressive CPAs to start shifting those assets. So
it ran into quite a bit of money. And as you may recall, back in the late 70s and early 80s, CD rates were close to 20%.
Right, exactly. And that's when I was mentioning that weight, earlier when we started speaking, I was thinking about the higher rates then, especially mortgage rates and CD rates have been in the news lately. And I have a financial planning practice, and one of my clients, very funny guy, he said, I bought my first house in 1982. He goes, I don't want to hear any complaining that mortgage rates are at 6.5% or whatever when we're having the conversation last. So
yeah.
Because,
so he probably refinanced when it got to 15%.
He refinanced a number of times. Yeah. Well, good. Well, that was very helpful, Jerry. Good. Thank you very much for coming on, sharing your knowledge and your experience with us as it relates to the kiddie tax. We hope to do this again, and I hope that those that listening at least picked up a couple of nuggets. That's always the aim of these podcasts, and we want to get you over the hump of that exam, whether it's the CFP or the CPA exam. They're not fun, but it's nice to see the letters behind your name. So, Jerry, thanks again for coming on.
Thanks for having me, Sev, and I know this will be a great benefit to the students, and it does help them along the way, for sure.
Agreed. So, okay, thank you.
You.
Take care.
Thanks for listening to this episode of the Earn Your Marks podcast. For more information or to get in touch, visit us at proexamtutors.com.